All right, I think we have most of our usual group here. We'll just get started right away. So Kelly, I hope you don't mind my saying so, speaking on your behalf, but Kelly is still not 100%, right? He's by 90, 95%. So we are going to preserve his voice a little bit, even though we have a lot that we want to hear from you, Kelly. But obviously we can't really do any of that until we get to, I know everyone's favorite part, which is the disclosures. So bear with me as we go through this disclaimer. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representatives and ensure that the iFlip Smartfolio that you select are suitable for your investment profile before trading in a live brokerage account. I know everybody loves that part. Okay, well, I mean, I didn't show the agenda, but yeah, we're just going to go through a market update and then do Q&A. That's it. That's the agenda, guys. Super simple. I'm going to stop share now. Kelly, you can take it.
There we go. Everybody. So we can see what the market is doing since the beginning of the year, which is where my mouse is, if anybody can see it. If you're just listening, the mouse is at January 1st or the beginning of January of 2022. And again, my voice is recovering. Wow, I was sick for 3 weeks, and then my voice went at the end of that, but I couldn't recover that. That's over 2 weeks ago, and it's still maybe even more, and it is still not complete. You'll hear it as I go on, and I will feign away. But that won't stop us for today because I definitely feel fine, and my voice is the only last holdout. I think everybody knows that the market is becoming volatile. Volatile in the sense that I think we all understand there is a change afoot. And we've been talking about this, I think, on the last AI, and we've kind of been leading up into this. And I have to reminisce a little bit about a job I took in early 1987. I left a company called Solomon Brothers. I was a trader at a portfolio manager, desk trader in the bond market. And I left to work for a guy named Paul Tudor Jones, who went on to be famous and a multi-billionaire running his hedge fund, which is now called the Tudor Group. And before Paul became famous, he was looking for this was 1987. He was bringing in experts looking for the top in the stock market because he felt deeply that the stock market was going to lose big at some point. I started with him on January of '87, and I was still in my 20s. And I remember there was a guy you can Google, his name was Tom DeMark. He would always come in. And he would talk about how, where is the short? Where do we get short the S&P? It took literally 10 months for that to occur. But ultimately in October of 1987 is when the financial crisis took place. But I think the more telling thing is what was occurring prior to the stock market going down, and how was the stock market behaving in the environment prior to its massive sell-off in October. We had a one-day sell-off, by the way, of 20%, one day. So as bad as that was, there was one thing going on that is actually going on today. And it was actually under a better scenario than the one we have going on today. In 1987, the bond market was falling apart. I'm going to bring up the bond futures. This is the 30-year Treasury market in the bond market for US 30-year Treasury. Notice COVID. Notice these are the prices. So when the price goes down, interest rates are going. When COVID came out, the interest rates spiked to go to almost 0%. I mean, in the 30-year bond, it became literally under like 2.5% when it was priced all the way up here. But look what has happened since COVID. This looks almost like an inverse. Anybody in the bond market has been destroyed. At that time was 189 in price. Today, we are looking, if I move all the way over here, we are here today, just off a low at 140. So we have lost 50 points in the bond market, 50 points. I remember very similar that this was the exact same thing going on in 1987. The bond market had been falling apart. And Paul, to his knowledge, even though he was a very young trader, recognized that stock markets are always late to the party. The bond market is always the smart money. The bond market is generally 40 times bigger than the stock market. That was back then, 40 times. In other words, way more people own bonds than they own stocks. But the bond market had been falling apart for around 10 months prior to the stock market giving up the ghost in October of '87. Well, in our case, it's now been 2 years. The bond market is giving up. No matter which thing we look at, this is a 30-year futures continuous contract. If I look at the TLT, kind of looks almost identical. TLT is the ETF for the 20-year bond proxy. It's not a future, it's something we can buy or sell. We are out of this particular contract in the conservative plus portfolio. But just notice the bond market is falling apart. Short-term interest rates have also gone down in price and literally up in yield. And the Fed funds rate, which is the way that people can borrow money, large institutions, is still at 50 basis points. So it is just a matter of time before the stock market gives up. Let's go back to the stock market. The stock market, let's look at this and itemize it. Well, here's COVID, the lows. Stock market went straight up. As you saw, the bond market went straight down. Now, they generally have an inverse relationship, but this is something a little different. And why it is different than the '87 crash is because now we have inflation. In 1987, I think all of us, those who are old enough to remember, we had already had our inflation. We're coming out of this in the early 80s. In the early 80s, at the end of the Carter administration and the beginning of the Reagan administration, what happened was we had massive inflation. Bond interest rates at that time were 12%, 13% on the long bond, 20% on the T-bill, which is the short-term interest rate. Pardon me, I have to cough. I'm doing my best.
Kelly, is it possible to zoom in a little bit? I think Judy would like to see the chart a little bit bigger, unless you need it zoomed down for a particular reason.
Let me see. I mean, this is the a full screen view. Is there maybe
right? So if you on your mouse wheel, if you actually like scroll up, it'll actually on the screen, it'll actually, zoom in, and then you can drag around.
Oh,
I don't know if Judy,
well, I'm not trying to zoom in. I want to be able to see a large picture. If I zoom in,
got it. Okay.
This is what's going on now. But this doesn't tell us the picture. The picture is told by this.
Agreed.
So
Right. Exactly. Okay. So
Judy, I'm looking very closely at a longer term picture to
there
be
you
able
go.
to explain my 2022 outlook and why, by the way, ultimately, all of our models are flat. It's not because I think that, it's because there's been a massive violation of almost every indicator we feed into our AI to tell us that we don't really want to have any long-term exposure to the markets. So I keep these screens kind of longer and tighter where they are kind of blurry probably on your end, even on my end. But it's to be able to show the concept that the stock market has risen since COVID and the bond market has had higher interest rates, ever since COVID was discovered. And if we look at this, my main point is going to be the following. If we look at these things itemized, let's start with the Dow, the thing everybody sees almost every day. Look at the Dow. It's closed here today, up, what was it, 250 points. But it is a joke. It is a 30 symbol index that is price weighted, not weighted by market cap. And it seems to show that the market is stable, steadying, trying to consolidate and go higher. That's what it shows. Because look at it, it's kind of hanging in there. It really hasn't gone anywhere since, let's look back. Here's where it is today. I mean, from a high that it posted literally in May a year ago, we're still where we were May a year ago. Next month, it'll be a year. Stock market hasn't really done anything. That's the Dow. Let's look at the Russell. Hey, from May a year ago, right around here. Russell's obviously lower and certainly off its peak. So the Russell's more around 25%. Let's now look at the S&P. The S&P from this high is down only about, it looks like 7 or 8% from here. But from in August of last year, we're basically where we were then. And let's look at the triple Q, the NASDAQ. Well, the NASDAQ, honestly, if you really look at it, it is priced where it was in literally 1 year ago in April of 2021. The NASDAQ hits the same price. The NASDAQ has been down as much as 30% this year, put on a little rally and then failed. So on the thing that most shows, if you go to CNBC or Fox Business, you will see this. And sadly, it is telling you a lie, in my opinion. And it's telling you that some index that we followed for most of our lives is not telling us the true story of what's going on in the market. The market is bifurcated deeply. Most of the S&P 500 stocks are well below their 200-day moving average, which I, by the way, have listed here as this orange line. If we go to most of these stocks in the S&P, they're below that, and they're mostly down 20 to 30%. What is holding up the market are stocks like this. Apple. Apple is only from a high of around 180. It's sitting at 167. And it is a component of the S&P. It represents almost 6% of the S&P 500, yet it is just one stock because its capitalization is so large. Ultimately, the point I'm trying to make is the systems see what is going on behind the scenes better than most of us do. That is why it is out. It is erring to safety. I suspect, sadly, that we are definitely entering a time where at some point this year in 2022, when certain fears of either an inflation that may run away and get much worse, an economy that we know may stumble if interest rates go up, and now they're being forced higher, not just by the Fed, but by some hawks on the Fed, like James Bullard and others who are now looking and calling for 75 to 100 basis points raises in interest rates on the Fed funds in the coming months. And so we have a market disclaimer because my personal opinion happens to agree with all of the data that comes out of both the algorithms and the AI, that the market is due for a serious correction, pardon my laryngitis, and that we are in a very dangerous time. I'll go to some other stocks, like look at Amazon. This doesn't look like a stock I really want to buy, as much as it's a great company. If I go back to July of 2020, right, like a few months after COVID, the stock has gone nowhere. The stocks that seem to be remaining and holding on are the ones you suspect, the dogs that used to be the dogs. Let's look at ExxonMobil. Well, here's COVID. Look at ExxonMobil. Look at what the red oils portfolios are. Let's look at those. Energy Transfer, pipeline. Look at this. There's COVID, pre-COVID. COVID kills these pipelines. Then we have Joe Biden coming into the presidency in 2021. And their pipelines, right? He gets rid of the pipeline, the main one, the capstone. And guess what? What do you think has happened? Look, the pipeline companies are going up. In other words, the market sees that policy will have to change. It's at all-time highs since COVID, and it's actually approaching the prices it had pre-COVID. Very close. Let's look at another one. The other one is PAA, All Plains America. Here we go again, very similar. Here's COVID, pre-COVID, and here's the depths of COVID. It's not doing as well as ET, but take a look, it's at $11 a share. There is no reason to think that here's a stock that could go back to, say, $20 a share, or possibly $24 a share. After all, better or worse, forget the politics, Joe Biden will not be the president forever. These companies, they're all LLCs, by the way. You might notice if you get a K1 on them. These are companies that I like personally. That's why we still have red oil, and that's why there's a concentration in these stocks for red oil. This is a stock that could easily double. And again, it's my opinion, I opine. But guess what? That's interesting that some of our algorithms will also manage these positions, and they will start getting back into All Plains America and ET. And it's still fine to own them. Matter of fact, I think we own ET, and it'll probably soon buy PAA. And if it does, you guys, we really want to kind of just hold these kind of things, because one thing is for certain, in this kind of an environment where everybody in the existing administration hates old energy and dark energy, and they're very green, it's just the exact opposite will always happen. The market recognizes that the world is not ready to make these changes. And lo and behold, we likely have a war as a result of green policies, if we look deeply at it. There are a million political reasons that we want to be long oil stocks. And the main one is because our existing administration doesn't like them. That tells me what I remember from Wall Street is we like what the main doesn't. And that means these kind of stocks. So if you're green, I understand not to buy them. But if you just want to make money, I still recommend red oil in its existing concentration. And these are stocks that you should, either own or look at to own. There are other stocks out there. And by the way, these things still pay dividends. Heads up, they still pay dividends, even though they don't have the revenues that they had before. So interestingly, they kept their dividends and their prices went down. You got to give credit to companies that manage themselves, that they're still willing to do that, even though their share prices have been slashed. I particularly like this All Plains American, by the way. Let's look at another kind of interesting stock. Here's US Steel. It's at all-time highs too, after COVID. So if we look at COVID, whereas COVID's begin, here we are, March. Look at Walmart. Can't go anywhere. The big box stores, it's done well after COVID. This is a stock I, for example, don't like. I don't like this particular stock. All it's done is it was in a bear market prior to COVID. COVID helped it out because they shut down the country, but not shut down these kind of companies. Now, by the way, I know there's certain people out there that have a vested interest in Walmart, but please retire. So we really want to keep an eye on these stocks. And if we own them, these are things I'd be very careful with. They may have a little more room to go, but under the existing economy and a possibility that has started to show and manifest itself of a potential recession. I don't expect it this year. That could occur next year. The market will react way in front of that. So sometime I feel before September of this year, I think we're due to see even the Dow Jones, even the Dow, the one that holds out the most, to really price itself not at 35,000, but more like down here, 28,000 to 26,000. And now that is a massive sell-off, but it's really no worse than where COVID was. Look at where it was at COVID. It's not unrealistic to think that the market is ready to roll over. It will not go gentle into the night, folks. I remember, again, that's why I reminisced early. I remember waiting and trying to be patient with it, but the stock market just could not give up the ghost. And so to this end, it's very difficult for me to find things I like outside of the oil sector. There's a few other things I think we should maybe examine a little bit before I hopefully have some questions from you guys. Let's look at Bitcoin. As a matter of fact, let's look at Bitcoin itself closely. As you know, it's been painful for all of us, and me in particular, hoping to get our Bitcoin product out there early in this year, and then to be held hostage by the Bitcoin vendor. But it is very close. We're there. It's just some things called tokens. But this is the price of Bitcoin. Let's look at Bitcoin itself. I'm sorry. Here's Bitcoin. Closed today at about 41. There's priced at 41,000 or so here. And Bitcoin hasn't really gone much of anywhere. But at the same time, we kind of know, if we look at the history of it, which there's the total history, that it's something that at one time we could buy very cheap, like around 4,700. It was cheaper than that before it started getting tracked. And now it sits at 42,000, coming off of around 68,000. So if I look at this, folks, I kind of feel that it has some level that it's correlated to the stock market. Here again is COVID, but after, when people had nothing to do, they bought Bitcoin, and then it does its normal crazy volatility. I suspect Bitcoin by the end of the year is going to be challenged by lower stock market prices and the fear of greater inflation and a recession. So it's kind of hard to buy it, but I do feel in the long term that this is still a market we want to own. And if you own it, I really wouldn't do anything, but it has the ability to be challenged later in the year if what we suspect, or at least myself suspects, is a market that could easily lose 20 to 30% at some point in this year. But I'm going to do something interesting here. Now here, by the way, is the Global Bitcoin Trust, which we've had prior to this, which is the proxy for Bitcoin. Let me show you something, everybody. This is a sneak preview of something we want to offer. So here is the Global Bitcoin Trust. Now I'm going to put in a second chart and compare the two. Now we're looking at, here's the price of Bitcoin. And let me get rid of a few of these things. Well, actually, just hide them. Just want to hide these lines. The lines mean nothing. I was asked one time, what does that line mean? What happens if you go over a line? And I realized, the line means nothing. In a global macro sense, a line is just a line, a moving average or a standard deviation. It really doesn't mean much. Let me tell you something about this. This is one of the products that our soon to come hedge fund will offer, and we'll offer it in a different kind of degree on the platform. But you might notice something. If this is Bitcoin, this is the Global Bitcoin Trust. They're priced different. But one thing that should be noted is that Global Bitcoin Trust will always trade below Bitcoin. Always. It must. There's two reasons. One, to own the Global Bitcoin Trust, it costs you 2% a year to own it. So it means that there has decay, where Bitcoin doesn't have decay. It's just basically about 0.5% and maybe a little cheaper sometimes to buy it or sell it. But there's another reason, and I'll share it with you if you all any of you care to look up the construction of the Global Bitcoin Trust. So the Global Bitcoin Trust, actually, when you buy it, it is actually not buying essentially one-for-one coin for every dollar that is added to the ETF. At the end of the day, there's a discrepancy. They own less coin than they technically should to be able to exactly match the Bitcoin. They hold it in reserve for managing the fund itself beyond the 2%. So in a way, it's a little disingenuous. But if you look closely, it can never, if it were to go bankrupt and everybody got a coin for all the money they had in it, whatever the price was, they wouldn't have enough coins to pay back everybody to match the current price of Bitcoin, which means that an arbitrage exists. There's people already executing on this particular arbitrage. If you look very closely, there's better charts for this. You'll see there's times when there's great disparity, like look at here at this price. Here's Bitcoin. We know, forget the price, but just notice the difference in price. It's pretty wide right there, this area here. But let's look over here. If you can see it, it's maybe a little blurry. Notice that they're very close. What this tells me is, this is what I used to do, is, hey, in a case like this, I'd like to buy Bitcoin and sell the Global Bitcoin Trust. And when that spread widens to be more like it was here, you notice it's wider, I would now sell Bitcoin and buy the Global Bitcoin Trust. In other words, I can build an oscillator. I won't show it to you on the screen, but if I did do that, you would see there's something called an over and under. And we want to trade that because that creates very little risk and high reward. So those are the kind of things I look for, and to be able to trade that. Mostly that would be done algorithmically because that's something called a stat arb, or statistical arbitrage. So these are kind of the things that I just wanted to point out of what we do and how we try to code it and be able to offer that to all the people on our platform. And some of the higher technical things maybe in our soon to be released hedge fund that will be focused on Bitcoin and other cryptocurrencies. Finally, I'm going to look at one more thing I think that's interesting, and it deserves something to touch base on, and that should leave us enough room for any questions. As you can hear, my voice is going. Let's take a quick look at gold. Let me get rid of Bitcoin here. Delete that. Let's go to, here's a chart of gold. As you can tell, gold lately has made some highs. It was over 2060. It's hanging out. I'm not a big gold bug or anything, but if we move into a moving down market, you can expect gold to make new highs above 2060 at least, and if not much higher. This is a market that, again, I'm not willing to trade it myself, but it is still the proxy. And gold market is starting to think very much a little bit behind the bond market, that there's something afoot in the overall market that could be problematic. So gold is pricing itself above where its main price tends to be when things are good, basically about $1,800 an ounce. But things have changed in there as well, and there's still a bid to gold. Okay, I got to touch on the dollar. I'm sorry. I want everybody to know, by the way, the dollar is basically making all-time highs. We had highs before here where the dollar actually went to above par. We are at par on the dollar, which means, because it consisted of the euro, it's a real good time to take a trip because the dollar is extremely strong. The dollar will get us literally almost $1.08, which means that burger that used to cost €5 at McDonald's is now going to, in France, is now going to cost you literally, okay, $5.40. So the dollar is extremely strong in all currency. British pound, it's only $1.30 on the British pound. And that's after Brexit. If we go back to Brexit, here's Brexit, 2015, here we are. This was the kind of the Brexit numbers, this thing here, where it got low, but we're there. This is the kind of the lows of Brexit. We're kind of moving in that direction again. If interest rates go up in this country, just remember, that means that, believe it or not, a lot of people will sell their other currencies and buy our dollar, making it become much stronger than it already is. So I'm kind of a bullish on the dollar, because if you can go here and interest rates keep going up, you got to own US dollars. So make sure you juxtapose that about what you hear in the news. Hey, and let's look, and finally, I want to get back to my final thing. I'm going to put up, let's put up the thing we used to like, and I kind of still do, a cruise line. Look at these cruise lines. A while back, as some of you guys remember, we were very excited about those after COVID. So we built the Spy Eye. It had some cruise lines in it. We still maintain them. When people started to realize this thing the COVID wasn't so bad, it rallied, got these things all the way up above 30 on Carnival. Now Carnival sits at around 20, 1962. And I like these. Now look, if we go into a recession, these things are going to take their time. But these are things, again, if you're a long-term holder, later in the year, let's keep an eye out. These things will be reformed. These are things that could easily go back and literally triple. These are the kind of things that are how people really make money. If you have the wherewithal, Main Street can make money on these things. Wall Street doesn't care. Wall Street will not think over 3 years. A takeover artist like a Carl Icahn may, but Wall Street will not. They don't care. Main Street needs to keep an eye on things like this, because these are stocks that deserve to be at a higher price. They're just there now because, again, COVID has taken too long. And people are afraid. Even when the masks came off yesterday from people, a lot of people kept their masks on. Remember, we all I feel myself, COVID is over. When I got sick, it wasn't COVID, it was a cold. And those things still happen. But I think in the grand scheme of things, I point out some of these stocks because I'm allowed to opine in here. And these things can still be held inside some of our portfolios. These are things to kind of stick with because they still haven't been hurt by the portfolio rules, knowing that their long-term goals are to literally go from this kind of a price back to the COVID recovery, which is more like 40, let's just call it on the cheap end, $44 a share. That's more than double. So we've talked about The dollar, we know it's at all-time highs. We know gold is higher than its normal hangout price, and that it may go higher. We've talked about the energy sector being solid still and very likely to be solid going forward. I can definitely see Exxon over 100 and the pipelines literally bucking the green trend and going much higher. And I see the interest rates going much higher. You notice all the prices of interest rates were on their lows. And finally, I showed everybody a little bit of a teaser of how we plan to look at Bitcoin, not just as a thing to own, but as a thing to trade against a proxy, which I showed was the Global Bitcoin Trust. And the same thing holds true with Ethereum and others. So if there's any questions out there, I think I've spent kind of a larger market update in terms of a global macro perspective, and my thoughts for towards the over the summer and going into the fall on the market.
Perfect. Thank you, Kelly. If you don't mind, I'm going to give your voice a little bit of a break here, and I'm going to take on some of these questions that I know that I can answer because they're very product related. But if you don't mind, you can stop the screen share so people can see us instead of the chart that we're not going to be referring to anymore. Let's start off. Go ahead.
I'm
sure. Okay.
Thank you.
Okay. All right. So we do have a couple of questions. I'm not going to take them in any particular order here, but who do I contact about changing my portfolio? I used to talk to George Boatwright. Well, George is still very much with us, and you can absolutely reach out to him as well. But the neat thing about our app since maybe a year or two ago is that you don't have to talk to somebody in order to change your assets, right? In order to change your portfolios, except for if you're one of the handful of people in Canada. So I don't know, Judy, where you're from. The Canada folks still have that little bit of a clunky process, and we're working on it. We're very close to fixing that because Velox now accepts Canadian customers, so we're able to as well. So yes, please reach out to George if you have any questions like that. Let's see. And we did have a question that came from, and I did type in a response. Kelly says that the Dow can drop as much as 10,000 points. How is the AI of iFlip going to protect us from feeling that drop? Well, if you don't already know how our AI works, it's going to do its best to estimate where the market is too risky it's not worth staying in anymore. And it's going to do its best to get you out of it. It's not going to go short. Let's be very clear, right? In case you guys didn't know that, for anybody that's new, it's not going to go short, but it is going to sell out of your existing long position.
Yeah, if you might notice, most of the people's portfolios, if they are in that should be large, a lot of them should be in cash. So if you're in the SPY Plus or the SPY I, you'll start to see, or even in conservative, you'll start to see that you have cash positions right now. And some of those might go away. However, you may not see that go away if you happen to own ExxonMobil or Red Oil. So those things will remain in the market for now. So again, these things are designed to protect even more if the market should go down to at least my expectations. But we do have large cash positions. If I look at over the horizon of our clients, we're almost 80% cash. So if you're a person out there that has 50% cash, well, that's a whole lot better than having 100% cash if what I say is right. And by the way, if what I say is wrong, and there's a chance for that, who knows, you can pull a rabbit out of a hat. You still got 50% in. But I think almost everybody on this call, I would hope, would agree that for the first time in a long time, there is a lot to worry about. Since
we're already on that subject, Gene has also asked, roughly 70% of the red oil is in cash inside of iFlip.
Right, but take a look closely. Those things are going to change actually again shortly because I've actually been watching them myself. So don't be surprised to see those things getting back in. very shortly.
Burton Lee asks, has the volatility associated with the 4Q rotate smartfolio performed as expected? I think he's asking, given the volatility that we've been experiencing, has 4Q rotate performed as expected?
Yes, it has performed as expected. Sadly, it hasn't performed well. It is a long-term concept to trade over a long period of time, because it does have the ability to have deep excess returns. But again, we're in a market, it's not so much the volatility, we're in a market that is in transition. A lot of you might have seen trades that occur for a few days where you'll be in the market for a few days and lose a little bit of money. When you start to see that happen and reoccur, generally that means the algorithms and the AI behind it are in this teetering mode where it can't predict and it can predict sooner. And right now we've gone to can't predict. So you won't see as much of that kind of chop as you did before, because it's kind of squarely in the can't predict market. So yeah, I trade the 4QR as well. I'm involved in that. And I feel, yes, it's traded as expected, but sadly, just like the market itself, it's transitioning. And so therefore, I would love it to do better. I think it's, and I think it will. However, in the near future, the way that works, is this: as the market declines, it will find 10 new stocks, but it'll find 10 new stocks. Those things will start to turn into things that look like utilities, stocks that don't move that much and are able to perform in a down market, which means they'll hang in there, which it means it shouldn't have any of the losses of the overall market, probably through this quarter, which is a brand new quarter, April, and the following quarter. I suspect it'll make larger changes when the market really goes, if it does do as I suspect, and move deeper into stocks that look like utilities. It could move into, for example, it could even move into oil stocks, because guess what? They're the ones that have the performing vectors. So don't be surprised to see the 4QR look, and maybe in some way a little bit like red oil.
Thanks for that clarification, Kelly. I'm going to take the next couple of these. Jonathan, any chance for Tesla? I think you need to be a little bit more specific, because you can absolutely add Tesla to your own custom smartfolio. We have Tesla in one of the preset smartfolios in Mod Plus, I believe. So if you could be a little bit more specific on what you mean by any chance for Tesla. Thank you. David, is there a way to set up the AI to follow a 30-day rule of buying and selling so it doesn't buy within 30 days of a sell? Our app, our product isn't one where you set up your own if-then conditions to titrate into the existing AI. Kelly, I don't know if you have any thoughts.
My comment on that
is a 30-day time frame.
Yeah, a lot of times people, algorithmically, a lot of times people like the ideas that if say you put in a trade and it gets out 3 or 4 days later and you lose, it does it again and you lose. You want to give it put it in the penalty box. All the effort I ever did algorithmically on that doesn't work. That means you're eyeballing something and trying to fit the curve to say, I'm just going to say, no, it needs a break. It's like a child, you put it in a punishment, go to your room, close the door. But at the end of the day, it's better to work out the problem, let it work itself through. It's sometimes painful, just like kids. It's something I could do, but every time I've ever attempted to penalty box something algorithmically, for example, you get no added value. There's no efficacy to it. There's one question I want to answer on this one, and then because it may be one you were getting to, but does it make sense to take a loan against a 401k and repay the pay it off after a correction? In other words,
I was going to get to that next. Yeah.
Okay, I got you to it. My thinking is no. When the market goes down, it's like when you take out a loan, and it means it's going to be at some interest rate. the market's going to go down, say it goes down 25%, and we say, hey, some of these stocks are going to be cheap, we're going to go buy them. Just note that the interest rate at that time, the broker loan rate, is not going to be what it is now, which is attached to the Fed funds rate. It's going to be much higher. I mean, I can say to everybody later this year, don't be shocked to see a Fed funds rate at 4%.
Mhm.
And that becomes a hurdle when you do it. So it is something to examine where the broker loan rate will be at a later time after a correction. So my answer to that would be no, not yet, but it is always something to look at if you're aggressive. If
Mhm.
you're extremely aggressive, to take out loans to buy stocks, it's aggressive later in the year.
Well, I would add to that. I 100% agree, Kelly. That's exactly what I was gonna say that, so that you didn't have to, so we could preserve your voice for a little bit, but whatever. But the only thing I would add is it's only worth it if you have an idea for if you have a strong belief for an investment that's going to overcome everything, that all of the shortcomings and fees and costs that Kelly just illustrated. So I don't know that that's probably going to exist in the stock market as just a buying opportunity, investing into an asset. But if you have something else, maybe you have maybe because you can take the loan out against your 401k and do like a real estate project with it, or some other kind of business venture with it that you really believe in, that's going to take advantage of a poor economic climate, then okay, sure. That's a different question though. That now we have to assess the viability and the success probability of that said investment, and then compare it to the stock market, climate. So it's a question that easily becomes way more than about, should I take a loan? Is it worth it to take a loan against my 401k?
I hope we're answering that question correctly, because I can read much into it. Maybe,
yeah.
Deborah, if you maybe add a little more.
It's a great question.
Yeah, add a little more, so make sure we're answering it correct. Why don't you go to the next one? Let me take a quick stab at Tesla, because I know you've already answered it, and I agree with your answer, and we want a little more, but maybe the little more was this. It's like this, what will happen to Tesla if all of this unfolds the way we've discussed? And look, all ships, rise in a rising tide. All ships fall in a lowering tide. So Tesla is, and it's hard to bet against Elon Musk, because I won't do it. But I could tell you that it wouldn't shock me to see Tesla at 750. That's 25% lower than where it is now. But I mean, Tesla has a history of doing things like that. And so I don't know if it'll hold out, but I suspect that if the market does what unfolds the way we've discussed earlier, Tesla will go with the market down.
And from a fundamental point of view, Elon Musk is also known as someone who can move markets with a tweet. There's a handful of people like that. And so when your CEO is somebody like that, there's naturally going to be suspicion when Tesla makes big moves up or down. And so you have to factor that in, and that makes a objective assessment of price action on Tesla much more difficult, because of that fundamental variable that you wouldn't otherwise have in like an oil company, right? You don't face that fundamental variable. Very quick question, Kelly. Do you see a scenario where Bitcoin diverges from the stock market?
Yeah, I do.
Yeah, okay.
I do, of course I do. Otherwise I wouldn't, for example, we wouldn't have been adding the crypto component necessarily to our platform, and I wouldn't build literally a hedge fund around it. Of course I expect that. I think because it's a new product, it's infantile, right? It's a 2-year-old or 3-year-old kid. It's a little older than that, but it behaves like a 2 or 3-year-old kid. It has tantrums. That's why it goes up and down. It doesn't know what to follow right now. So it follows what it thinks it should, which is the stock market. If all is well, in the stock market, let's buy Bitcoin. But it's interesting that most people that trade, when they trade, they buy the stock market and they just feel good or bad based on the stock market. But I can tell you that the bond market is a much bigger market than the stock market is. And the bond market's giving off this incredible signal to say, we got trouble afoot. And for example, if you own Bitcoin, you're a crypto believer, if you were watching that market, maybe you would be selling it. Because now the cost of carrying Bitcoin is higher because it means that interest rates are higher and that money could be earning you a rate from the government opposed to the volatility of Bitcoin. So it just depends on what people watch. And right now they just watch the stock market because that's the natural thing for people to watch because it's more exciting than the bond market. But the bond market is more knowledgeable and it is smarter money. So I follow the bond market. But it will diverge in the future, everybody. And it will diverge because of, I think, the main economic reason. I have debates about it. And in fact, I just debated that guy, Charles Lee, the one that's on TV. I think it was Charles Lee.
I don't know him.
And he's on TV all the time. I feel it'll be a global currency, everybody. If it's a global currency, I think, sadly, that the US is losing its position in some ways as a worldwide leader. I think we'll gain some of it back, but I think the trend is not good in this country. And these things have a long-term repercussions. And a younger generation, I think, wants this. And it's out of the hands of my generation to prevent it. Even if I was even in charge of any political station in any sovereign government around the world, if it becomes a global currency, here's some simple math of why it'll diverge. Right now, for example, Bitcoin represents about $1 trillion in market value, but the GDP around the world is about 85 trillion. That's 1/85th of worldwide GDP. It doesn't take a rocket scientist to figure out that if we can solve a few issues, like for international trade, like instead of using a banker's acceptance note, we have a currency that can be exchanged between the two companies, eliminating a bank. That'll be way more efficient. The banks will no longer be able to be the middlemen to make their millions. Things become much more efficient and actually cheaper. They're deflationary, they're good. Mm-hmm. And guess what? If we just say, and if to do that is where most trade occurs, that's in the trillions.
Right.
So say we go to 30 trillion. Well, that's 30/85ths. Well, that's 30 times higher than it is now. It's at 40,000. Multiply 40,000 by 30. There's why people can come up, they use that kind of math to come up with $1 million a coin. Mm-hmm. And by the way, or more. And by the way, it's not the wrong math. It's some function of that. Right. That's why it will diverge.
Yeah, it definitely has the potential to that. From a more technical perspective, this is just my opinion as well, but I don't think what we're going to see, I disagree with people who think that we're going to use Bitcoin every day to like buy pizza and stuff, because it's fundamental, it's just too slow. For retail, it's still too slow, but for what Kelly's talking about, for just international transactions, the pros outweigh the cons greatly, even as it is constructed now, aside from the volatility and it's not widely adopted. Technically speaking, it's already better than a lot of the way that you have to deal with international middlemen and banks and stuff like that today. So there is it's just a matter of, is it going to be adopted widely by different countries, policies, and large scale businesses, and then that's the big domino. Once that falls, everything else will just fall into place, I think, anyway. We do have a couple more questions before we wrap up for tonight. Denise, hi Denise. If I understand what you said, I have 500 to invest in the energy sector, and cruise lines are good to check out. Any others? Those are really good. $500 is a really good fit for our SPY-I smartfolios, which is, it has cruise lines. It has got a little mix of everything that is a COVID recovery bounce back kind of a play, and red oil specifically. A lot of our other smartfolios require a higher level of investment. Like the minimum is like 1,000 or 3,000 or something like that. So $500 is a really good fit for SPY-I and red oil, which encompass both of those types of stocks that you mentioned. Let's move on and let's look at okay, Deborah is going to clarify about her 401k. To clarify, I was thinking to take out the loan now, then as a correction occurs, the 401k will be worth less, then repaying later the stocks, get in later because the cost basis is lower. Okay, so that you could do that. It sounds like what you're trying to do is simulate what the iFlip AI would do by getting out, at the highs and then waiting out, the correction and get in when the price is, it's a good deal. It sounds like you're trying to simulate that within your 401k. And that's just a lot of manual work. And if you're not already experienced at doing this type of market timing, it can be, I understand it's a company 401k, not individual. Of course, yeah, right. That's why you don't have control over it. It can be very stressful to have to do that manually. Because what if we have a situation where Kelly's absolutely right, but it takes 10 months for him to be right? That means, and let's say you took the loan out now, right? And the market doesn't tank for another 10 months. That's 10 months worth of stress and interest on your repayment that you have to deal with. So what I might do, and Kelly, I might want your opinion on this, is there are ways, depends on your company 401k, there are ways for you to invest in something that simulates like a money market type of situation. Kelly, do you have any other types of?
I do. I want to get to, there's a couple other ones as well.
There's a couple
and
more.
I want to get to those as well.
Yep.
So we'll do those and then call it a day.
Yeah.
It's great to, by the way, see everybody on this, because I'm glad.
Yeah, everyone's so active today. I think everyone.
By the way, I wanted the one I missed. I think a month ago was the one I really wanted, because that was actually an anniversary of COVID, right? The March.
Oh, that's right.
20th, I think, or 23rd. The one I couldn't make because I had no voice, was literally the anniversary of COVID. We set it up that way. I'll quickly go to Deborah and then Scott and John. So I see your point now. And the way I answered it was incorrect to what you're trying to do. What you're doing there is essentially becoming like an option, where you're trying to say, I think over this time, the market does this, that gives me an advantage. Sort of like, I think over the next 6 months, this stock is going to go lower. So I'm going to take a 6-month option on whatever this stock is and buy a put, because I think it's just going to go lower and I got 6 months and do it. I can tell you what'll happen. When you start to have to time things, it does become expensive. I've noticed this often in life where the idea is sound. It is definitely sound. Take the loan out now because your portfolio is more valuable, and you can go to a bank and they may lend you 75% on it. But sometimes they have, just be aware that if you, depending on the loan, there could be issues. They might say, well, if your stock value drops by 50%, we're going to call some of that loan back.
Mm-hmm.
So now you've paid interest on it, and they're asking money to come back to them because they're worried about the value of the loan they gave you. Now it's only where the loan is for 50% of your money, and the stock goes down 50, your pension goes down 50%. You could be in a kind of a pickle. So that's one, but I see your reasoning. The reasoning is sound.
Mm-hmm.
I would have to know more particulars to answer that one valid. So
right.
That's one that we should probably take a little bit offline. And again, anything I would opine would just be that it would be an opinion. And you would have to have a real good plan to manage that. So right. I love the idea. It is clever, and it's that people do it, but there's a lot of little caveats you need to be aware of should you do that. It in many ways, it does make some sense.
Right.
But again, we don't want to try to get too clever here. I would need to know particulars, or we'll take that offline. I want to answer John's question. Yes, I am considering making a commodity portfolio, a smart folio for commodities. There's something called there's a Goldman Sachs commodity index. There's a Morgan Stanley commodity index. These things are on the rise. I don't disagree. I'm looking at it. If I have something out, it would be probably within the next couple of weeks. So I am definitely considering that. It makes sense to have some money in some kind of index like that. Good call, good question, John. Targets for Scott Henderson. Yeah, on the Bitcoin, my thinking is I'm nervous about the price of Bitcoin in the short run, because I think if this market goes down, the most obvious thing it seems to be correlated to is the market. So I would expect Bitcoin to go down on any first move of the stock market going down. So I think maybe we should start looking at that in around June, July. In other words, I don't think this is going to be, buy in spring and walk away kind of thing, and selling, it's sort of because everybody goes away, the stock market bubbles up during the summer. This is a different summer, I feel. And I think it'll take to decouple ultimately, I think will actually probably start to occur later this year, because I think the stock market, if it moves lower, some people in Bitcoin will make up a stand, and they won't accept that any kind of coupling later in the year, because they'll just think it's valuable. Like, I'd like to own it myself if it's at 28,000 on a Bitcoin. I mean, just own it and say, I'm willing to risk, if I bought a whole coin, 28 grand, for the fact that it might go up 3 times that, which is just the old high, basically. So why wouldn't I take that bet?
Right.
And so I think that kind of covers it. I think later in June, you start to look for the targets to maybe start to look at buying Bitcoin and or somewhere through the summer, and only do it when you know the stock market has gone down. If the stock market stays steady for some reason, then Bitcoin should probably stay steady as well, and maybe move higher, but not so much higher. I think the world is waiting for some kind of a break to occur. It needs direction right now. And God knows, pardon use of the Almighty, none of us have the answer to that. Yeah.
Well, I think that does it for all of the questions. Kelly, I have one for you.
Sure.
And you mentioned something that to me that stood out to me. You said that the stock market, and this is coming from Paul Tudor Jones during your tenure with him. He said that the stock market is always late, and the smart money is the bond market money. Could you expand on that a little bit? And if the bond market is so smart, then why don't most people trade the bond market and not this? And why are most retail investors in the stock market?
Bonds are generally owned in people's 401ks, like Deborah's. They have concentrations of bonds. Bonds are the 40 of the 60-40 portfolio. But if you go into large pension funds, like a CalPERS or a CalSTRS, the California teachers, the California, all of those, these are things that own huge amounts of bonds. And by the way, remember, bond issuances are from all over the place. They're not just the federal government, they're municipalities and states, and even private groups like General Electric borrows, right? All companies borrow generally, unless you're a technology company. So most people don't realize the power of the bond market. I learned that in the 80s. And in the 80s, remember, interest rates were much higher. They have been low for 40 years. For 40 years, we've been in a secular bull market in bonds. In other words, lower and lower interest rates. It looks to me like we've topped. And these things are generally things that are part of a super cycle.
What makes the stock market delayed and the bond market a little quicker to it?
Because companies can absorb higher interest rates for a long period of time to still make profits. Let's face it, if at 1%, if it moves to 2%, a company says it's an extra percent, our profit margins are 30%, say, it's not going to damage my bottom line that much. Maybe I'll make my dividend a little, instead of offering that extra dividend, I won't offer it.
Gotcha.
I still have a good stock. There comes a point though where it hurts. And what's happened now is we have inflation. And when the inflation comes, these rates can go up very quickly. We just saw the long-term rate for a person to borrow a house, to buy a house and a mortgage, go from 2.5 to just about 5 in 2.5 months. So when you see interest rates move up like that, that definitely will have an effect. But don't be surprised, folks, to maybe see a mortgage rate go up to 10%.
Right.
Quickly. And that'll be done by the Fed at some point when we have a knowledgeable Fed chairman to be able to recognize what's upon us. And secular bull markets like the bond market will end, and so will the stock market. I hope it's not the stock market, but a correction is definitely reasonable. But put that aside, this is the first time the bond market is giving off a huge warning signal. There has been no other time like this since the financial crisis 14 years ago. So if we deny that signal, then we're really all in denial. So, and that's a major part of how our AI works. It looks at the bond market. So it's a very important market.
Thanks, Kelly. I never quite, I knew that they were inversely correlated for the most part, but I never heard that the bond market is the smart money and the stock market is well, we knew that the stock market was delayed, but I never knew why. So I appreciate that answer. Thank you so much for that. And that about does it for tonight, everybody. Thank you so much. You guys were so active and engaging today. It was very, very nice to see. It feels good to be able to do this again with everybody. We are going to ramp up these for the remainder of the year and moving forward. We just took a little bit of a break during the first quarter of the year because of the crypto class and Kelly's health and little things like that. So expect more of these to come. Stay tuned. Everybody stay safe out there. Trade well, and until next time, good night.
A month from now, all the very best to everyone. Thank you so much again.
Bye-bye.
Bye.